To Joseph Stiglitz, that's going to come in now at $2 trillion. So yeah, of course, when they start these things, they always figure out that it's, just a few $1 billion, but it has a tendency to escalate quite rapidly. Now, Ron Paul has called this form of perpetual warfare, as you call it, military Keynesianism. Do you agree? And maybe explain a little bit about what Ron Paul is saying there.
What I think is actually going on is that you can look at it in terms of Kennedy's fall of great empires. The reality is that the United States, after World War II, was, on a relative basis, in a much better position than we are today. So the question has been since then is how to sustain some degree of economic power, and military power is a way to sustain that. Over time, what we've found is that the benefits of the military incursions haven't really accrued to the U.S. domestic economy. More, it's been the military-industrial complex. So we're at the point now where the benefits of the U.S. military far outweigh the costs in terms of money. For instance, the United States spends as much money on its military as the entire world combined. That's a huge drag on the U.S. economy in terms of alternative uses of that money, in terms of infrastructure building, education, things of that nature.
But that's been true for decades, right? There has been no cost-benefit analysis for America's military forays going back 30 years versus the unemployment, the infrastructure collapse, the educational fall-off, the health standard collapse, the falling of America's competitiveness around the world, the decrease in America's increase in infant mortality versus the other industrialized nations. There hasn't been a cost-benefit analysis to spending trillions on war for decades, right?
Exactly. So, we're in a long sort of haul toward, keeping the status quo going without the benefits accruing from that status quo. And you've seen the same thing with other powers. Eventually, there's some sort of incident which causes a rethink, because the decline of that particular country has gone on. You look at the UK and the Suez Canal incident in 1956, how that was they realized at that point the jig is up. We can't really support this level of empire. We need to draw back.
Let's talk about quantitative easing for a second. Does perpetual war mean perpetual quantitative easing? I don't know if you saw Jim Rickards' piece recently on King World News, but he talks about how the talk about QE3 coming up in June is a misnomer, because the Fed's balance sheet's roughly $3 trillion. So the maturing of the stuff they've got on their balance sheet already means perpetual QE-type money printing in perpetuity. Is that the case? And does perpetual war go along with this? Can you comment?
My thinking is that the political constraints for the Fed are a lot greater than the hyperinflationists and the people who talk about things money printing on end would say. You have a lot of people who say that you're going to have QE3, QE4, it's going to continue on and on. But the reality is that the Fed is constrained politically at this particular juncture. They're not going to be able to go all in and with QE. I think that we're done after QE2. The question is what happens if the economy, or when the economy relapses? Will the Fed be able to up the ante and go for more, or will we have some sort of systemic crisis? And I think that politically they're so constrained that I wouldn't bet on a QE3 happening before some sort of systemic crisis happens.
No matter what scenario you paint, it looks like higher interest rates are coming at some point. And this, of course...
I don't know about that, actually.
Okay, so...
let's look at Japan as an example. The reality is if you look at the interest rates, as generally speaking, interest rates for longer-term maturities are an expression of the expected short-term interest rate. There's obviously some risk premium for holding assets that are longer dated, but the reality is that if the Fed has 0% rates forever, then there's no reason to expect 5 or 6% rates for 10-year bonds. So if the Fed signals we are not going to raise interest rates anytime soon, there's a huge arbitrage opportunity at that point for someone to go out into the market, buy up a bunch of long dated assets, and then short them in some way with treasury strips or something of that nature. So the reality is that this whole argument that interest rates are going up is constrained by the fact that interest rates are 0% for short dated for short dated treasuries.
Well, that sounds all semantic and pretty much hogwash, and that's why gold and silver is bolting higher. People who are buying gold and silver, like John Paulson, who's now going to be the richest man in the world very shortly as soon as gold crosses 5,000, listen to your arguments and they say, what are you talking about? You're just adding more, you're just injecting trillions of credit with this arbitrage. Are you crazy?
No, not at all. There's a difference between currency depreciation and interest rates. Just because my currency depreciates by 15% or 20% doesn't mean that interest rates go up. You have a prima facie evidence with Japan. Just take a look at Japan. Do you see interest rates at 7%? I mean, these guys have 200% debt to GDP. And people like Rickards have been talking for 10 years that Japan is going to have some sort of massive debt spiraling. It's not happening. So right there, you have the evidence that it's actually not true.
Well, let the market decide. How about why not if the Fed steps? Hey, hold on a second there, buddy. How about let me get in here.
The market has decided.
Let me step in and ask my question. Let's say, why don't we have the market step up, have the Fed step back, and see what is the true demand for U.S. 10-year notes and 5-year notes out there in the marketplace. And now, if you take the Fed, which is the biggest buyer of its own paper, you've got Bill Gross at PIMCO saying, once the Fed is removed from the equation and Japan's no longer buying, China's no longer buying, there's no longer this artificial market, who's going to be buying U.S. Treasuries? How are you going to keep the interest rates artificially cheap then?
Well, as I just told you, if interest rates are 0%, you will have buyers. At a minimum, let's just paint a scenario. Interest rates are at 0%. The Fed stops buying. Asset prices stop being elevated. You have a systemic crisis of some sort. The United States, GDP swoons. Immediately, people will go to treasuries as because of the flight to safety. They'll go to treasuries over risk assets. You have a perfect scenario right there for a decrease in interest rates. And as I said, if the Fed says, 12 months out, the economy's looking bad, we're going to have rates at 0%, obviously, if you're buying a 12-month, a 1-year treasury, why would you pay 3% for that treasury when, in fact, the Fed has already told you that rates are going to be 0%? It doesn't make any sense. All you have to do is do the math.
Do the math, okay? What you end up with is negative interest rates. And that's loss of purchasing power, and that's a reason to buy gold and silver, and that's a reason for hyperinflation as people completely lose faith with these fiat currency magicians and scoundrels in your town, Washington, D.C. No wonder you're viewing this in this way. You're being corrupted by inside the beltway thinking.
Not at all. The reality is hyperinflation is a political it's a political action. It has nothing to do with the money. The reality is hyperinflation occurs in specific circumstances, and those circumstances are political. That is a loss of faith in the currency, tax evasion, foreign currency liabilities by the central government, and some sort of a loss of productive assets. Those are the preconditions for hyperinflation. You don't get it just by printing money. You certainly can get currency debasement, but you don't get hyperinflation. It's not true.
All right, now Japan has announced that they're going to issue some reconstruction bonds that, for the first time in history that I'm aware of, they're going to be backed by the Bank of Japan. Now, is this the first bond collateralized entirely by the printing press in your knowledge, Ed Harrison?
Well, all bonds are collateralized by the full faith and credit of the governments that issue, in fiat currency. It's not as if it's backed by gold or silver. So obviously, the reality is for any particular bond, it could be monetized by the fiscal or by the monetary authority.
Yeah, but they're saying that the bonds have no connection to the underlying economy. They're just going to print up a bunch of paper and use it as a medium of exchange, even though it's inherently worthless. I mean, that sounds unsustainable to me. But I know that you're a paper bug and you love paper.
I'm not a paper bug whatsoever. Actually, I think that fiat currencies are not the way to go. I believe that actually we should go away from fiat currency, but I do have a better understanding of the money system, the fact that in a fiat currency system, none of the assets are actually, or none of the liabilities of the government are backed by anything other than the faith and credit of the nation that's issued the paper. The reality is they can always print out more money if they wanted to do so. That's true in the United States, and that's why hyperinflation, as I said, is a psychological, it's a political event. It's because of a loss of faith in the currency. As long as the legal tender laws are there, as long as you have to pay taxes in a currency, basically you have nowhere to go. That's the reality.
Okay, that's all the time for we have this week with you, Ed Harrison. And thanks so much for being on the Keiser Report.
Thank you, Max.
All righty, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Ed Harrison of CreditWriteDowns.com. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.